Warren Buffett has sprinkled us investors with tons and tons of useful advice over the years. It's actually pretty insane how much useful advice comes out of that man's mouth. But this particular 1962 interview stands out as how it is directly relevant to investing today. If you're investing today, you need to have seen this interview and you need to understand what this interview is. So that's what I'm going to do and break down in today's video. But first, I'm going to set the scene for 1962, give you sort of an overview of what the markets were like before this interview took place and while this interview took place, so that you can further appreciate what is happening in this interview. Then I'm going to play this interview for you and I'm going to provide some explanations and some commentary on different parts of the interview so that you can understand what it means. And then towards the end, I'm going to explain how that interview and how what is said in that interview is directly relevant if you're investing in today's market in 2019. So if you do enjoy this video, the best way that you can let me know is by hitting that subscribe button and hitting that notification bell so that you get notified next time my videos come out. But for now, let's start off by looking at how the market was looking like in 1962. What was the market like during this interview? In terms of the stock market, from December 1961 all the way to June 1962, the S&P 500 dropped from about 610 points down to 465 points, and this represents about a 24% decline in stock prices in just 6 months. And this was so big that it has a name, and it is called the Kennedy Slide of 1962. In April of 1962, US Steel, which was a company that had about 25% market share on steel in the United States, made public their plans to increase their steel prices by 3.5% per ton. The US government fired back and decided that they were going to be changing a lot of their submarine contracts, which involved a lot of steel, naturally, to smaller companies that were not planning on hiking their steel prices. And as a result, US Steel, the company, decided to roll back their hikes. They said they weren't going to do it. Now, the details of these events is not what's important, because that event is what triggered the decline, but it was not the root cause, as Warren Buffett explains in this interview that we're going to watch right now.
I think the president's action on steel probably had something to do with the timing of the decline, but I don't think it was the factor which determined the amount of the decline.
So there it is. Straight away, Buffett says in this interview that even though the events triggered the decline, they were not the root cause or the cause of the magnitude of the decline.
For some time, stocks have been rising at rather rapid rates. Corporate earnings have not been rising, dividends have not been increasing, and it's not to be unexpected that perhaps a correction of some of those unusual factors on the upside might occur on the downside.
So Buffett here is saying that while the events of the US Steel government conflict did trigger a decline, the cause of the decline was much more widespread. It was actually as a result of stock prices rising while stock earnings and dividends did not. So the underlying value of those businesses on the stock market was the same, because they were earning the same, they were paying the same dividends, but the price that investors were willing to pay was going up. And he thinks that the decline in 1962, that was about 26%, was a result of a correction of this case.
Well, some observers from time to time say that the stock market is a forecaster of events to come. Can you predict, or would you care to take a look at what you think this might be forecasting, the decline?
The stock market has been a good forecaster from time to time in the past. It also has been a rather poor forecaster occasionally.
So the interviewer here asks Buffett whether he thinks that the stock market is an accurate forecaster. And Buffett essentially says it does try and forecast the future, but it's forecasting. It's not always right. Forecasting means that the market is coming to a consensus, coming to an agreement about what is going to happen in the future. Are corporate profits going to rise? Are dividends going to rise? And the consensus in 1961 or late 1961 was that they were going to rise, and that did not materialize, which meant that the stock prices needed to come down. So sometimes it's a good forecaster and sometimes it's not.
For example, the last 4 or 5 years, the stock market has been booming along and presumably forecasting better business, which has really not materialized. Corporate profits are not any better than they were 5 years ago, but stock prices are 50% higher or thereabouts. So maybe the stock market is really correcting a previous incorrect forecast this time rather than making a new correct one.
This is a really interesting part of the interview, and I think it's really important, and it's easy to skip over this part if you're not listening closely. He essentially says that sometimes it's a good predictor, but sometimes the corrections are just recorrecting for a previous miscorrection. So, and really what this means is that there doesn't have to be a recession in order for the stock market to correct or the stock market to come down significantly. If their corporate profits might be going up, businesses might be earning more, dividends might be going up, but if prices are going up too fast, then maybe sometime in the future that's going to correct and they're going to come back down to levels that they should be. But business doesn't actually have to be bad in order for there to be a correction. Business could be great, but the stock prices could be going way too high.
Well, in a nutshell, Mr. Buffett, can you give us your opinion of just exactly what happened, what caused it?
Well, there was undoubtedly some forced selling the week when the stock market hit the news. The previous week, prices had declined about 6% for the week on average, and there was some stock that was forced upon the market both by margin calls from brokers and some that was forced out by improperly secured bank loans. And this in turn set up a self-generating mechanism on the downside for a while, which we may have seen the last of and which we may not have seen the last of.
And that is my favorite part of this interview, which we may have seen the last of and which we may not have seen the last of. Buffett here again, he doesn't try and predict what the stock market is going to do. He does say a little bit about what caused it. There was some more pressure on the downside. He says a few technical things that a lot of you might not understand, but he's not predicting that that is happening. That's to be clear. He's just observing what happened in the past, because we can look back and see exactly what happened. But looking forward, he says, I don't know. I don't know what's going to happen in the future. And it really doesn't matter what is going to happen in the short term. You just need to look at the underlying businesses that you own and compare their earnings to the price that you're paying. So now that we've looked at 1962 and what happened around there was an event that triggered it, but really the root cause was that prices were rising while earnings were not. And then we had a look at the interview and heard Buffett explain that. Then how is that relevant to today, to 2019? Well, let's take a look at the S&P 500's price and compare it to its earnings over the past few years. S&P 500 over the past 12 years has risen from 1800 to 2950, which is up 64%. Meanwhile, S&P 500 earnings are up from 103 to 135, which is just 31%. Now, as you can see, S&P 500 earnings per share has grown by 60%. So stock prices over the past 12 years are up 64%. Earnings per share is up 60%, but total earnings, meaning the earnings for the whole company, not on a per share basis, is only up 30%. So on a per share basis, it looks like the stock price increases are justified. But the important question to ask here is, why has earnings per share risen by 60% when actual total company earnings has only risen by 30%? And the answer is that companies are buying back stock and reducing the number of shares outstanding, reducing the number of pieces that their corporate profit is being broken down into. And while share buybacks do return value to shareholders, they do not increase the overall value of the company, the amount of earnings that the company can produce. So what does that mean? Well, it means that companies are taking on debt and using most of their earnings or a significant amount of their earnings to buy back stock, which increases the value of each share, but does not increase the value of the whole company. They're not reinvesting to grow the earnings of the company. They're just deleting shares so that each share becomes more valuable or is perceived to be more valuable. And the problem with this is that the overall company is not growing. They're just reducing the number of pieces of pie that it's split into. But that is going to hurt businesses over the long term, because businesses need to reinvest to make business better, not to just delete shares and to cut the pie into a smaller number of pieces. And like Buffett says, who knows when the corrections are going to happen, and who knows how significant they're going to be. The only way to protect yourself in the stock market is to be an actual investor, not a speculator. And that means that you look at the businesses that you understand, you calculate how much cash you can get out of them over the long term, and then only pay a price that is substantially below that. Anything else is speculating, and anything else is going to get you severely hurt at some point in the future. We don't know when, we don't know how big the damage is going to be, but it will come, and if you're speculating, you should be very, very worried. As I said earlier in the video, guys, if you did enjoy this and you want to show me that you want to see more content like this video, I put a ton of effort into this video, then make sure you hit that subscribe button and hit that notification bell. And if you're already a subscriber, thank you very much, and just leave a comment down below. Any kind of engagement like that helps out so much. But thanks everyone for watching, and I hope you guys have a great day, and I'll see you in the next one.